Hey everyone, and welcome to This Explainer. Today we're going to do something that is honestly incredibly empowering. We are taking the essential concepts of personal finance straight from the comprehensive SEBI financial education booklet and transforming them into clear, actionable building blocks for your future. Look, whether you're just starting out or you're already looking to sharpen your financial edge, understanding how money actually works is literally a superpower. We're going to strip away all the complex jargon today and just focus on the core principles that dictate whether your money is just sitting there or if it's actually out there working for you. So here is our roadmap for the explainer. We'll cover the basics of savings and investment, inflation and compounding, proper financial planning, banking and safe digital transactions, and finally, investing in the securities market. All right, let's dive right into Section 1, the basics of savings and investment. Now, there is a massive difference between simply keeping your money safe and actually putting it to work. Savings is basically just money you haven't spent yet. It's highly liquid, meaning you can grab it instantly, and it carries very low risk. It's your safety net, absolutely perfect for emergencies. But then you have investment. This is money that actually has a job to do. It's put to work specifically for long-term wealth creation and designed to beat inflation over time. Sure, it might not be as instantly accessible as a savings account, and yeah, it involves some risk, but make no mistake, this is the true engine that drives your financial growth. You can kind of think of your wealth like a giant balance scale. An asset essentially pumps money into your pocket without you having to actively clock in and work for it every day. Think of a fixed deposit or shares in a company. A liability, on the other hand, like a loan you owe, constantly drains money out of your pocket. The real secret to wealth isn't just snagging a high salary. It's about consistently buying things that act as assets until they completely outweigh your liabilities. Moving right along to Section 2, inflation and compounding. The clock is quite literally always ticking on your cash. Inflation is just a hard reality of economics. It means that the 500 rupees sitting in your pocket today is going to buy you significantly less in 5 or 10 years. It's a concept known as the time value of money. If your cash is just stuffed under a mattress or sitting in an account earning less than the inflation rate, you're actually losing purchasing power every single day. It's a silent erosion, and that is exactly why we absolutely must transition from just saving to actively investing. We have to outpace that clock. So how do we know if we're beating the clock? Well, the rule of 72 is a brilliant, super simple mental math trick you can use right now. You just take the number 72 and divide it by your expected annual interest rate. The result? That's exactly how many years it will take your money to double. So say you find an investment yielding 6% a year. 72 divided by 6 is 12. Boom, 12 years for your money to double. If you can get 8%, it only takes 9 years. It's just a fantastic, quick way to evaluate an investment's potential on the fly. And to really drive home the power of reinvesting your interest so it earns even more interest, we have this famous quote, often attributed to Albert Einstein. He supposedly called compound interest the 8th wonder of the world. Compounding is what happens when your interest starts earning its own interest, creating this incredible snowball effect. In the early years, you barely notice the growth. But give it a few decades, that curve sweeps upward dramatically. Starting early is hands down the single greatest advantage you can give yourself. You definitely want to be the one earning it, not paying it. Okay, let's get into Section 3, proper financial planning. We really need to stop relying on vague wishes and start setting SMART financial goals. SMART stands for specific, measurable, achievable, realistic, and time-bound. Saying, oh, I'll save money is just setting yourself up for failure. It's way too vague, and human nature guarantees you'll find a reason to spend it. The right method is saying, I will save 4,000 rupees every single month to reach 48,000 rupees in a year. See the difference? That gives your brain a highly specific target, a clear timeline, and a way to measure success. Same goes for paying off debt. Precision is absolute power when it comes to financial planning. And to protect those SMART goals, you need asset allocation. This is essentially the golden rule of not putting all your eggs in one basket. By dividing your investments up, say across equity, debt, and gold, you balance out your risk. Equity, or stocks, act as the high-speed growth engine for your portfolio. Debt, like bonds or fixed deposits, acts as your shock absorber, giving you steady, safer returns. And assets like gold act as a solid hedge against inflation and economic turbulence. Mixing these together gives you an all-weather portfolio that can take a few market hits while still growing over the long haul. Building on that, we have the universal rule of finance, the risk versus return trade-off. It's a simple upward slope. Seeking higher returns naturally means you have to accept a higher level of risk and volatility. You simply cannot get equity-level returns with savings account-level safety. Understanding this trade-off is crucial because it stops you from falling for those shady, get-rich-quick schemes promising massive returns with zero risk. Let me be clear, in the financial world, those literally do not exist.
Let's pivot to Section 4, Banking and Safe Digital Transactions.
It's vital to instantly recognize the difference between the cards in your wallet. A debit card uses your own hard-earned money. Swipe it, and the cash leaves your account right away. No interest charges because it's yours. A credit card, though, that is essentially taking out a microloan from the bank every single time you tap it. You're using borrowed funds. If you pay off the balance in full by the due date, it's an amazing tool. But if you don't, you get slapped with massive interest rates that can wipe out your wealth-building efforts overnight. And because digital transactions are just how we live now, you need to treat this checklist like your digital armor. Changing your passwords regularly and never, ever using public Wi-Fi for your banking are your absolute first lines of defense. And it goes without saying, but never share your PIN or your OTP, your one-time password, with anyone, even if they swear they're from your bank. Most importantly, if something looks sketchy, report it immediately. Getting that report in within 3 days drastically increases the chances of the bank actually being able to protect your funds. Finally, let's step into Section 5, Investing in the Securities Market. Before you buy a single stock or bond, you've got to understand the environment you're walking into. There are actually 7 distinct types of market risks you have to navigate. It's not just a vague fear of losing money. There's inflation risk, which we talked about. There's liquidity risk, meaning you might not be able to sell an investment fast enough when you need the cash. There's business risk that's specific to the company you're investing in. When you break risk down into these categories, you stop fearing the market and you start respecting it. That's when you make calculated, informed decisions instead of emotional ones. To actually get into this market, you can't just hand over physical cash, obviously. You have to set up a specific pipeline. First, you need your standard bank savings account to actually fund the investments. Second, you link that to a trading account opened with a SEBI-registered broker. They're the ones who execute your buy and sell orders. And third, you need a DMAT account, which is managed by a depository. Think of the DMAT as a highly secure digital vault that holds your electronic shares. You need all 3 steps working together to invest properly. Now, a massive, game-changing leap forward for everyday investor safety is the modern ASBA process using UPI for IPOs. Back in the day, you had to send your money away when applying for an initial public offering, and if you didn't get the shares, you just sat around waiting for a refund. Today, under ASBA, your money is simply blocked right there in your own bank account. It actually keeps earning interest for you, and it's only debited if and only if you are officially allocated the shares. It's incredibly seamless, and it totally protects you. Well, we have covered a ton of ground today. From the magic of compounding and the rule of 72 to asset allocation, digital safety, and how the securities market actually functions, we've laid out the building blocks to secure your financial future. So I want to leave you with this one final thought to chew on. What is your very first SMART goal going to be today? Don't just vaguely promise to save more money, make a real plan. Thanks so much for joining me for this explainer, and I seriously can't wait to see you start building your wealth.